Mara Delta Property Fund today released their results for the year, and it shows revenue for the year shot up to just over $25.2 million. That's versus $16.5 million seen in the previous period. Now, profits for the operations also increased significantly. But to tell us more about these numbers and the considerable growth in the distribution too, upwards of 4%, is Bronwyn Corbett, Chief Executive of Mara Delta. Always good to speak to you, Bronwyn, and thanks for making time.
Pleasure. Thanks for having me.
As we were discussing very briefly off air, clearly a job well done given the volatility that we see in the market, and a lot of naysayers might have said, you know, this African growth and expansion story just doesn't hold water anymore given the wins that the continent has been facing. But paint a picture for us regarding some of the highlights that improved the numbers overall.
So I think it's exactly that. So we've been very excited by the numbers because of the macroeconomic challenges that have faced some of these jurisdictions. And I think, you know, what has been our key focus has really stood us in very good stead in relation to the numbers, and that is having the strength of the counterparty. You know, we talk about counterparty. So having international and astute brands into whether it's your retail schemes or your offices, you know, these guys can sustain difficult markets. And I think that's what we've seen out of the portfolio. So even though we've got a big holding into Mozambique, our numbers have still been exceptional with the IMF withdrawal, because with having Vodacom and Anadarko and Hollard and KPMG as our tenants, these guys can sustain a sort of macroeconomic challenge that's been happening currently. So I think during the sort of a year, the key aspects is the growth into other jurisdictions. So we've now expanded into Mauritius, Kenya, as well as Zambia. The intention from a strategy perspective is that we would not want more than 20% exposure to a particular jurisdiction. I think the reality is that we are dealing with frontier emerging markets, and we need to respect that. And at some stage, one of these markets will tend to take a wobble. So it's important to mitigate the overexposure to a particular market, or being completely reliant on commodities, for example. You know, we've got a big focus into East Africa. Their business model is built on other things besides commodities. Mauritius is another aspect to us. You would have seen we announced the acquisition of one of the hotels on the sale and leaseback. So we're not getting involved in hospitality. I'm not taking hospitality risk, but the reality is we're looking for that strength of the counterparty. So Lux is an exceptional brand. We're signing a 10-year Euro lease. You don't have any challenges with it reverting back to local currency rupees. It's a solid Euro lease, which is critical in these markets. And I think that sort of stance that we've taken as a management team into these jurisdictions has stood us in very good stead. And having distribution growth of in excess of 4% sitting in dollars it's an excellent story for the continent and real estate.
I'm glad that you bring that up, because so often when we attend these property summits and have discussions regarding investment opportunities on the continent, dollar leases are always brought up as an area of question and sustainability. In your view, how is this going to be a competitive advantage for Mara Delta over the long term, given the risks that are available in the market? And are you open to mixed baskets of currency exposure?
So, you know, I think there are realities in Africa, and you can't pretend that those realities don't exist, and one of them is the local currency challenges. And I think what we want is a balance of a couple of things. So one thing is the ability to access true hard currency. And what does that mean? So you have Morocco, which is a pegged currency. So it's pegged to the euro and dollar. So that gives us proper hard currency exposure. You have some of your hospitality brands that will sign these leases. However, on the retail, to force your moms and pops to sign dollar leases is a mistake. So we do like a balance. So in Zambia, for example, we have 15% of our income is exposed into kwacha, but we can then service local operating costs and VAT and those things. So there is still an element of requiring local currency to still do business in those countries. So for us, we can believe that you're able to do both. So you're able to still look at the hard currency, but still not put your smaller tenants under that pressure, which is not sustainable going forward. Our model in retail is smaller retail. We like 8 to sort of 12,000 square meters. We find that that's resilient in relation to when the markets do blow out in a necessary sector. You're not sitting with luxury brands. People still need to shop. People still need to go and have their cell phone fixed. And it's having those centers with the balance of your nationals in dollars who can sustain those dollar leases, but then your sort of smaller second tier shops in the local currency.
Bronwyn, to wrap things up, in a threefold question, given the limitations on time, you've raised quite a bit of capital and looking to continue growing growing quite aggressively on the rest of the continent. Would you ever consider the likes of Europe, if some of your peers have already mentioned in the past? And secondly, with all this capital being raised and the listing that you have on the Mauritian Stock Exchange and here at the JSE, do both listings still make sense?
I knew you were going to ask that question. So I think we are seriously looking at the capital structure going forward, and it's exactly that. So where does the interest come from for Africa, and where do the investors sit? And I think it's, you know, when you're going through a transition in a fund of our nature that's so complex, it's important to look at both of the exchanges and say, you know, where do we see our capital in the long term sitting? So we're going through that analysis at the moment. We are not interested in Europe at all. I think that a lot of our counterparties are doing it, and they're doing it fairly well. Africa needs focus. Focus, focus, focus. So we are now going to be focused and working in 7 countries. South Africa won't form part of our investment mandate at all, and that will be pure focus on high GDP growth economies and economies where we see a significant impact that something like Mara Delta and the real estate business can make.
We'll leave it there for today, Bronwyn. Thank you so much for your time. Always a pleasure speaking to you. That was Bronwyn Corbett, who's the Chief Executive of Mara Delta.